If you are a homeowner with an existing mortgage loan or perhaps looking to buy a property, well, then this program is just for you. Rising interest rates for mortgage loans has been a concern for many since March 2022. How will this affect the property market? Is it still a good time to buy a property? What about existing borrowers? Should you refinance your existing housing loan? I'm sure these are questions that many of you want to find out. Hi everyone, this is Alex Chua from Home of the Elites and welcome to another episode of Always Ask Alex. And today we'll be discussing mortgage and you. Our guest, Clive Chng, is an Associate Director from Redbrick Mortgage Advisory, and he is very passionate when it comes to helping his clients build a property investment portfolio, something they can be proud of. With a reputation for his insightful perspectives on real estate investments and cash flow management, Clive stays on top of market trends to keep his clients ahead of the game. His clients in banking, human resource, and finance industries love working with him because he provides a clear, actionable, and impartial advice. This program is brought to you by Home of the Elites Private Limited, a boutique real estate agency with a primary focus on luxury homes, and Redbrick Mortgage Advisory. You can check us out and follow us on our Facebook page or subscribe to our YouTube channels to learn more about what we do. Remember to turn on your notification and you will never miss any of our programs again. So if you are ready, let's welcome Clive.
Thank you for having me.
Okay, so Clive, I understand that nowadays, I think since March 2022, a lot of my customers have been asking me about the rising interest rates, whether is it still a good time to buy a property or whether should they refinance their property. And of course, for most of the viewers out there, their biggest question would probably be, how are mortgage interest rates determined? Because I understand that previously you have the SIBOR, and then currently they are using the SORA.
Yes.
Yeah, so perhaps to share with our viewers out there, to have a better understanding of how interest rates are being determined.
Sure.
Yeah.
Okay, so I think many of us are very familiar with previously the main benchmark rate was SIBOR, the Singapore Interbank Offered Rate. Ever since January of 2021, actually we have introduced SORA, the Singapore Overnight Rate Average, which is actually going to be the main benchmark interest rate for mortgages in Singapore. Now, the main difference between SIBOR and SORA is that SORA is actually based on actual interbank lending transactions, meaning to say transactions have already happened. Right? If you look at SIBOR was actually based on quotations. So the actual transactions haven't yet happened, right? So having SORA pegged to mortgages is actually going to make it more robust and less susceptible to actually manipulations in the market. Because I think there was some history about SIBOR. It was actually phased out because even the LIBOR, the London Interbank Offer Rate, I think some banks were manipulating the rates. So the government wanted a more robust rate and hence came out with this SORA, overnight rate averages. In fact, I think a lot of countries are already transiting to an overnight rate average instead of an interbank lending rate. So it's going to be more robust, more transparency, and one more thing is that it's backward looking. So meaning to say that when you had a mortgage pegged to SIBOR in the past, and when SIBOR increased, you felt that increase immediately, right? But now when SORA increased, for example, by 50 basis points or 60 basis points, they would actually take the average of the last 1 month or the last 3 months, right? Depending on whether you're on a 1 month or 3 month SORA, and that will determine your rate moving forward. So your rate doesn't spike up due to a sudden spike in interest rates. So it's more gradual kind of a movement as well. So it's backward looking rather than forward looking as well. So that's the two main differences.
Okay, so I'm sure most viewers will also want to know how will interest rates affect the mortgage?
Yeah. Sure. I think that I would first like to address a very common misconception. I do have clients coming up to me and saying that, hey, my interest rates have increased from 2% to 4%, right? And my mortgage is going to double, right? But when you look at it and you measure it, I mean, the mortgage monthly installments don't really double, for example. So I'll give you a certain example. If you have $1 million mortgage on, let's say, a 25-year loan tenor, if you start off at 2%, your monthly installments will probably be about $4,200. And if that increase of 2% goes up to 4%, for example, in interest rates, your monthly installments goes up to 5,002, right? So it's like $1,000 jump. You don't really double the kind of mortgages. So, but definitely higher interest rates are increasing debt burdens for mortgages or for owners in Singapore's servicing the mortgages. But I think that is really part and parcel of the government's effort to really try to bring down inflation, right? Especially in the US as well. I mean, US inflation is really high, and accommodation or shelter contributes to a large part of inflation as well. So it's deliberate that interest rates are made higher so that people feel that debt burden, so then they'll stop spending a little bit, or they'll cut down on spending on other things to bring inflation down.
Okay, so we know that since somewhere around March last year, interest rates have started to increase.
Yes.
Okay, and just out of curiosity, how have home buyers responded to this increase in the interest rates?
Okay, so I think Singapore is a very unique market, because if you look in 2022 or even before that, the property market in Singapore was actually much more resilient than other countries. And even though interest rates started to climb ever since March of 2022 when the US Federal Reserve first hiked interest rates, we still saw a very healthy number of transactions in the market. In fact, I think property price index was still continuing to go up, right? The market was still a little bit exuberant. I think that has got to do with a few factors as well. Yes, although interest rates started climbing, but if you are a landlord, if you have an investment property, you would realize that your rentals also start going up, right? There was a lot of demand for rentals. And when rentals go up, it helped cushion the impact of higher interest rates as well, right? So landlords are able to hold on to the property even longer. And if you have, for example, right now, you and I know that rentals is quite healthy. You can easily, almost in some areas, double the rent that you're getting before. So really, I mean, landlords have that holding power. And if you really want to take that homes away from them, you've just got to pay a premium because they're comfortable sitting there, maybe even getting a positive cash flow. So I think that contributed to part of why rising interest rates didn't really impact the market, at the beginning of the year as well. But of course, as interest rates continue to climb, we are seeing a little bit of concern from some home buyers, having to service a higher mortgage. But even so, I think to begin with, in Singapore, because of your total debt servicing ratio requirements that prevent you from over-leveraging, I think a lot of homeowners before that are already quite conservative. They usually do not max out on the entire total debt servicing ratio. Right? They don't max out their entire loan eligibility. So there's already a bit of a buffer built in there, right? So even if interest rates go up, I mean, they still are able to handle that, right? Because they've already set in certain buffers. And when the banks determine your loan eligibility in a rising interest rate environment, they also apply a higher stress test, right, to determine your loan eligibility. Right. So I think ever since COVID as well, people have a lot of savings. They're tapping into their savings. They're still quite cash-rich, a lot of cash in the bank. So I think that's why, even though interest rates have increased ever since March, the Singapore property market is still doing quite good.
Yes, indeed, because if I use new launches as a gauge, since March until even the last quarter of last year, new launches are still doing relatively well. It seems that many Singaporeans are still snapping up properties. Yes. So my guess is that probably they are concerned, but it's not really to the point that it will stop the buying.
And also to touch on that point, absolutely right. New launches, it's always following like a progressive payment schedule, right? So yes, interest rates may be high, but if you're starting off and progressively paying down, the loan is being drawn down progressively. In terms of cash flow wise, it's much easier to manage because small disbursements in the start, even if there's an increase in like even 1% in interest rates, for example, it doesn't really dent or create a hole in your pocket. Right? Because the increments that we're talking about on that smaller loan amount are very much more manageable, right? I mean, as compared to resale properties where the loan is dispersed at one lump sum, that increase in interest rates may hit you directly, and the increase, the magnitude of increase will translate into a higher monthly installments than building under construction properties as well. So that's definitely one of the considerations for some clients who want to go into new launches. I think it's because of the progressive payment scheme, it actually bodes well right? Even if interest rates go higher.
Okay, so a lot of my customers have been asking me, should they go for fixed rate or should they go for floating rates? And as far as I understand that even if it's a fixed rate, they probably lock it down for 1 to 2 years, and subsequently whether the interest rate goes up or the interest rate comes down, they will still adjust accordingly to their loan package.
Yeah.
Is that how it works?
Yeah. So mortgages in Singapore, unlike mortgages in the US, where you have like 30, 40-year fixed durations, right? Singapore is like, I think the maximum now is only like 5 years, and not all banks offer this. Generally, the banks offer you like a 2-year or 3-year fixed interest rate, after which you would always move into a variable interest rate after the lock-in period. That's why it's very common for people in Singapore to always refinance the mortgage, because generally when you come out of the lock-in period, that's where the banks will actually increase your interest rates by quite a fair bit, right? So I think the consideration, this is the golden question, should we go for a fixed interest rate or variable interest rate, the golden question. But I really think it depends on a few factors, and especially on a person's cash flow. For example, if someone comes up to me and says that, Clive, fixed interest rates are really high, it's going to be a stretch on my cash flow, and I cannot afford, for example, if I'm running a business, I cannot afford to have like certain inconsistencies in my commitments, right? And if I'm really stretched for cash, then I'll say, hey, bite the bullet, go for a fixed interest rate. Because if you go for a variable interest rate, yes, you may enjoy the upside if interest rates come down, but in the short term, if interest rates are going up, and if you cannot deal with that cash flow, it's going to, it's detrimental for your business, you don't want to risk that. Then go for a fixed interest rate, although it's going to be high.
Right.
Then for other clients, for example, they say, hey, Clive, I'm going to refinance my property. It's currently being rented out. I'm very happy. My recent tenant has decided to pay me more because the market is really good, right? So my rental that I'm getting is covering my entire mortgage cost, plus I get some more. So I have a positive cash flow. Now, these guys can take a little bit more risk, right? I can go for a variable interest rate, because even if variable interest rates go up, it's okay. It doesn't hit me, right? My tenant is still paying for most of the costs of this increase in interest rates. And I get to enjoy the upside if interest rates come down, right? So it really depends on a few factors like that. Also, if someone is buying or refinancing a property, then the considerations become, what then do you want to do on this property? Do you intend to sell? Do you intend to decouple on the property? Do you intend to, along the course of the journey, make partial repayments on the property, right? Depending on what you want, right, then we will try to match you with what is out there in the market. Because if you say, hey, Clive, I want to sell my property and I want to also have the flexibility to make partial repayments on the property, then going for a fixed interest rate may not be suitable, because fixed interest rates are very restrictive. If you want to pay down, if you want to sell, there's always going to be a penalty within the lock-in period. But variable interest rates, because you take on that risk, they will give you some flexibilities of paying down on the loan or even selling the property, and they will just waive off the penalties for you. So it really depends on a person's profile, a person's requirements, before we decide, whether a fixed or variable interest rate is better for them.
Right. So usually for your clients, if they come up to you, you'll probably sit down with them and find out whether would the fixed interest rates be better for them or a variable.
Yes.
Right.
Absolutely important to know what their requirements are. And then plus, after that, we have to couple this with the knowledge of what we think is going to happen in the markets, what is being priced into the markets. For example, how are the banks pricing fixed and variable interest rates? That will also give us a sign of where interest rates may go.
Okay, so for what would you advise? How to choose the best mortgage loans in Singapore?
The very interesting thing, Alex, is that there can be a lot of packages in the market, and it can be best for everybody, right? Depending on your profile. I think at this point of time, it's important to understand a person's profile first. So for example, when you purchase a property today, your loan tenure is always kept up to the age of 65 or 30 years for private property, whichever is lower at this time. Some people may be, of the older age, maybe 55 years, for example, even 60 years old. When they purchase a property, the loan tenure becomes very short, right? Now, one way that they can do is perhaps they want to consider going for a very short lock-in period, right? Why so? It's because, let's say, a 1-year lock-in period. Now, if it's a 1-year lock-in period, we can refinance them a year later, and when they refinance, they can actually stretch the loan tenure by another 10 years.
Right.
That would greatly, that would easily bring the cash flow, the commitments every month. It's a reduction of almost 50% or more. right? So it really depends on a person's criteria. Some of my clients really come up to me and say, hey Clive, I'm really tight. I really want a longer loan tenor, but I still want to leverage at 75%. How am I able to manage my cash flow well? Okay, go for a variable interest rate with a 1-year lock-in period. You refinance after a year to stretch your loan tenor, right? Other clients come up to me and say, hey Clive, interest rates are really high today. Instead of taking like a 75% loan, maxing it out, I'll probably just take lesser, So I just want to save on interest that way. So I tell them that there are actually a lot of ways in the market today that you can actually still leverage at 75%, but also manage interest costs, right? One way is this thing called an interest offset account. So clients who really have that liquidity, for example, okay, I have $400,000. I will take $400,000 lesser of a loan. I say, hey, you can actually deploy this money, this $400,000, into an interest offset account. So here's how it works, right? This money's in the interest offset account is liquid. So at any point of time you want to withdraw, you want to deposit, it's up to you. But as long as you have the monies in there, a certain portion of the monies, let's say 70% of the monies, is actually earning you that same interest rate that the banks are charging you on the mortgage, right? So the interest that you earn here would actually go into offsetting the interest on your mortgage. So your mortgage interest rates effective interest rates actually come down.
Right.
Right? And that's what you want to achieve, right? In partially repaying, you want to pay lesser interest. So we help you pay lesser interest, but you still have that liquidity. Because if you put this liquidity into the private property, it becomes a little bit illiquid, right? Can you take it out later? Of course you can. A private property, you can get an equity term loan, but you have to jump through a few hurdles to get the money out. And now when you get the money out, the banks charge you an interest, right? So we always have to understand our clients' requirements, and if they really have that cash, then I'll say, keep this money liquid, reduce your effective interest rate, but at any point of time that you want, maybe you want to purchase a second property or a commercial property, for example, you have that liquid cash there for you to deploy. So whether fixed or whether floating, it really depends on a person's requirement. Then yes, a part of it depends on, okay, where we think interest rates are going to go. Like for example, the current narrative is that interest rates would probably continue to rise a little bit more. But a lot of people are also factoring in, hey, a potential recession maybe in 2024, or a slight tapering of interest rates in 2024.
Right.
But the current short-term view is that interest rates would still climb, and for people who just don't want to take on any volatility, a fixed interest rate hedge for the next couple of years, that'll be okay.
Okay, Clive, so as a borrower, how would they be able to find out if they meet the TDSR requirements?
So today when you purchase a private property in Singapore, you are subjected to this thing called the total debt servicing requirements ratio. And that basically means that you can only use a maximum of 55% of your income to service whatever liabilities that you have, right? So if you have a housing loan, a car loan, a personal loan, and some other loans, it has to be within 55% of your total income. Now, total income has got a bit of a difference as well. You have, for those of you who are employed, you have like a basic income and you have bonuses, right? For those of you who are self-employed, it's just basic. The banks will lend you money based on how much you report every year, right? So basic income gets recognized at 100%. The banks recognize variable income, which is like bonuses, at 70% as well. So that adds together to form your total income. So as long as at the end of the day, your liabilities do not cross that 55%, that's okay. So it's assuming that someone earns $10,000, right? So 55% is $5,500. If you do not have any commitments at all, the entire $5,500 will be used to tabulate your loan eligibility, right? So it's very important to understand when you first embark on a property purchase, what kind of liabilities you have, right? And in order to get an indication of how much you can actually borrow, it's useful to get an in-principle approval from the banks. The banks would actually run through the credit searches, determine your credit rating, determine how much commitments you have, and give you an amount of loan that you can borrow. And then at that point of time, you can figure out, okay, if I want to increase my loan amount, should I be clearing some of my credit cards? Should I be clearing even my car loan, right? Because I know there's some people who have a car loan and they're left with like 1 or 2 installments, for example. And that 1 or 2 installments can actually increase their loan eligibility by another $250,000. They might be, okay, if I'm going to buy a house now, I'll just clear off my car loan and get that $250,000 more,
Right.
So understanding the impacts of that the commitments can have on your loan eligibility is important. But generally, yes, as a rule of thumb, you don't want your liabilities to exceed 55% of your total income. Yeah.
Right. Okay, so I understand that even for credit cards, I mean, the reason since you mentioned credit cards is that whenever I walk around in the shopping mall, there will be all these kiosks by the banks. There's encouraging people to sign up for their credit cards. So I thought that was quite a bit tricky, even if someone who carries, let's say, 5 credit cards, for example, but probably use one main card and one secondary card. But because of the other 3 credit cards that he or she is holding on to that they are not using, that will also affect the TDSR.
Yeah, but by a bit, right? So because if you have a credit card, you will always be like, I mean, sometimes they will charge you an annual fee. And this is quite interesting that you brought this up. I actually have clients, because when you walk along Orchard Road, for example, you sign up for a credit card, you get a very nice luggage or something from the bank.
Yes.
And everybody wants that luggage, right?
A lot of freebies.
Exactly. So when they sign up for the credit card, they get that freebie, and they don't spend on it. After a while, the banks would charge you an annual fee. So of course, if you're not spending on the card, you just call in to try to waive off the annual fees, right? So the banks will probably tell you, because you've not been spending on the card, it's going to be hard for us to waive off that annual fee. So what will you do? I want to cancel the card. Right? So a lot of people call in, cancel the cards. But sometimes, right, when you say, okay, I'll cancel the cards, the banks don't waive off the annual fee.
Right, okay.
And if you don't pay for it, it isn't waived off. It is left in your credit rating or your credit history, and that amount accumulates. And every month, so somebody may have a very strong income. Okay, Clive, I only have like 1 active credit card. But when we run the searches, we realize that, oh, actually, the history, like 2 years ago, you have a credit card and there's a very bad record there. And that prevents that person from borrowing, or there are certain conditions that the banks would actually impose on this client if they're looking to borrow from the bank. Right? So it's important to first ascertain the health by getting an in-principle approval from the banks, run through the credit checks to make sure that everything's okay before you make the commitment.
Right, so the freebie is not exactly free.
Everything, there's no free lunch in this world, right? Yeah.
Okay, so I suppose the next question that many of you viewers would like to find out is valuation. Because since 2020, sales price has been going up, okay, and many buyers have this concern, what if the sales price and the valuation couldn't match? What would the bank do?
Yeah. So I think it's very important before anybody embarks on purchasing a property to get valuation checks from the bank, right? Because that is the right thing to do, right? How do you know how much a property is worth at this point of time? You get a valuation check, right? And then again, I guess you guys will also help them with that. So we always want to take a more preemptive approach when we tackle this issue, right? We want to get the valuations from the banks first, and then we try to match it to whatever we're going to pay. So we know for certain if the bank comes back and say that, okay, this property is valued at $7 million, and you know that the selling price is like $7.5 million, right? We know that going into the purchase, you've got to pay that $500,000 cash over valuation. So that's certain, right? But if, let's say in the event where you know a client goes into the purchase and just makes an offer immediately, what we will try to do is that we will go to various banks and we will ask them for their valuations, whether or not we can push that valuation close to the purchase price of like 7.5 million, right? Valuations in the bank also work very differently from different banks. It differs. Different banks would have different credit guidelines provided to the valuers that would guide the valuation that they do. And the valuers would also have a different kind of methodology that they apply, right, to different properties as well. So there is going to be a range of valuations. So in the event that a property was already, an option was already given at 7.5 million, we would then try to look for several banks or ask several banks to see which bank can actually bring that valuation close or as close as possible to that 7.5 million, right? Because the banks would only grant the client 75% on that valuation or purchase price, whichever is lower. So as much as possible, we want to push it higher. So that's what we'll try to do.
Right, okay. Yeah. And of course, I understand that for landed properties, I mean, every sale is different.
Yes.
So it can be a big gap based on what the bank has in mind in terms of valuation and what is the actual sales price that took place.
Yes, correct. Yeah. I think more importantly for landed properties, because it's easy for condominiums because your size, the stack, it's all the same. It's much more easy to value. But when it comes to landed property, every landed property has a different design. Every landed property has a different built-in area.
Yes.
Right? It's gonna. You cannot just generally say, okay, if the property is like in this vicinity or this proximity, that all the properties are worth that amount, because some people may spend a lot more on renovation and A&A, for example.
Yes.
Right? So landed property valuations are much more tricky, and that's why when you get valuations from the different banks, sometimes you do see quite a wide range. Some banks may come back with even a 500 or even close to like $1 million difference in like valuations at the end of the day.
Okay.
Right? But I think it's important first when we talk about valuations to get that indication from the banks first. So then you know, okay, what is the rough estimate or what's the rough guidance for this? And once we have that valuation in mind, then we can go to a particular bank if the valuation is a bit low and say, hey, can you help me with a revaluation of this unit? Because the valuations that I'm getting from the market around this range, 7.5, but your valuation is like 6. So can you please relook into it and see whether anything can be done? So we'll do all this groundwork, which I think is really, really important before you even make the commitment to go into the property.
Right. And of course, recently one of my customers is looking at one of the unit that's off River Valley. It's a small development with 84 units. And the last transaction was almost like 3 over years back. So in such cases whereby there's not a very consistent transactions happening every now and then, how would the bank be able to gauge what would be the right amount to finance?
Yeah, it's still okay because the banks will always look at a certain radius, right? Be it 1 kilometer, 2 kilometers, or 3 kilometers, and the transactions that happen within this area. So it's unlikely that you would have a particular development and the surrounding 2 or 3 kilometers there is no transactions. So they will always use that as a gauge. And also, I mean, valuations are also just not looking at property prices in that area, but generally, how is the property market doing, right? How much would a property in this area fetch based on the methodologies that the valuers set out? So I think it's still okay. I don't think, and especially in Singapore when it's quite densely populated, it's hard to find like single plots of land and where the vicinity is like very scarce and you don't have transactions around the area. So a little bit unlikely that would happen. But at the end of the day, I think the banks, when we go and get valuations from 4, 5, 6 different banks, all of them reach out to the valuers, or the valuers would value the property. Generally for condos, the range would be within like $300,000-$400,000 now. The difference only. But still okay, still can value.
Yes, because personally I feel that the property market has never been fair to buyers and sellers at the same time. It's either a seller's market or a buyer's market. So in the buyer's market, basically every sale that took place, for the next buyer to come in, they expect to buy cheaper than the one before, right? But in an upward trend where it's a seller's market, every seller would want to sell higher than the last sale that took place, right?
Yes, definitely. They definitely take that into consideration as well.
What about those people who are self-employed? Example, real estate agents, financial advisors. I understand that there's this term that they use, it's called the haircut. Right. So what does it mean, and how does it really work for those who are self-employed when it comes to securing a mortgage loan for their property?
Securing a mortgage loan for business owners, for self-employed people like real estate agents or like financial advisors tend to be a little bit harder, right? We've got to work a little bit harder because as compared to someone who is employed, this person who is employed, their income would be recognized at 100%, right? The basic income. But because being a self-employed person, myself as well, income fluctuates, right? And because income fluctuates, that presents a risk to the banks. So the banks will not recognize 100% of whatever you're going to report in your annual income. They will always take a haircut. So basically the recognition of your income is only at 70%. They will take a 30% haircut, right? So that's the meaning of a haircut. And also for self-employed people, the banks would state that you have to be self-employed for at least a period of 2 years, right, before we would recognize your income. Because again, it presents the banks with certain risks. If I am a self-employed individual, I first come out and I become a financial advisor, for example, for a year, the banks still deem this as a little bit of a high risk because it's only been a year. What if you don't do this anymore, right? So those are the considerations. You have to be self-employed for at least 2 years. Now, there can be certain exceptions, for example, especially like business owners themselves. So I do understand that business owners, some of them pay themselves a regular income, right? Most of the banks, usually when you're a business owner, and you want to try to get a mortgage, they would run the ACRA searches. And of course, once they run the ACRA searches, they will see that you are the director of the company, you have 100% ownership. You will be automatically termed as self-employed. They will take a haircut of 30% from your income. But there are some banks that have certain credit policies that, if you are actually paying yourself a consistent income, right? All along when you first set up the business, there is consistent CPF contribution. There is proper records of the bank's, your bank statement showing that you have been credited that salary every month. We can make an appeal to have your basic income recognized as well, right? So that will actually boost your loan eligibility.
Right.
So yeah, but generally, self-employed people, we have to work a bit harder, right, in order to get the same loan amount.
Right, okay. So when you say 70%, I suppose, let's use the example of maybe someone who's self-employed that makes 300,000 a year. Then of course, he or she declared his operating expenses maybe 80,000 a year. So is that 70% based on 220,000 after expense?
It's 70% based on the amount declared.
Oh.
So if you declare like $300,000, 70% of $300,000 or $400,000. Yeah.
I see. Okay. So even though there's a operational cost for self-employed, so they don't deduct the expenses out.
No, they will look at what you declare.
Oh, okay. Interesting.
And 70% of that.
Right. Okay.
Yeah.
Okay. So Clive, one of the questions that have always been asked is that how can a borrower avoid paying the penalty if it is still within their loan tenure period?
Okay. So I guess like some of my clients come up to me and they ask me as well, hey Clive, if I buy into this property right now, but I also understand that the property is, the development wants to go through an en bloc, right?
Yes.
Or for example, if we want to move to another country at the end of the day and we want to redeem the loan earlier, right? This is going to be an issue. Okay, so generally in the market for mortgages, within the lock-in period, if you do decide to fully redeem the loan, meaning to say if you do decide to sell, to refinance, or even to fully pay down on the loan, constitutes to a full redemption. If you do this within the lock-in period, the banks would always charge you a penalty of 1.5% on the outstanding loan, right? But if you know that there's certain requirements like this, so some of my clients will come up to me and say, Clive, I want to buy this property, or I want to refinance this property, for example, but I do have the intention to sell and maybe buy another one later, right? If you do have these considerations, then we need to find packages. Banks do offer packages that will give you the waiver of penalty due to the sale of your property. So in the event you say, hey Clive, you know what? Okay, we're going to sell off the property, we're going to move overseas. Okay, sell it even within the lock-in period, the bank waives off the penalties for you. So we have to find specific packages that offer those features that will give you the flexibility that you want. Otherwise, you end up paying like a 1.5% penalty. Either that or you wait till you're out of the lock-in period and then you can sell, no issues. Because the constraints are always usually during the lock-in period, right, of 1 or 2 years. But once out of the lock-in period, you want to sell, sell. You want to refinance. There won't be a penalty.
Right. So I believe most people would definitely plan ahead, as in when they own a property, they probably will be there for X number of years. But what about those that unfortunate situation, maybe the sole breadwinner lost the job and they are not able to maintain the monthly installment? Are there exceptions to or exemptions to such a scenario?
I think generally at the end of the day, because the banks are private companies, and if you don't make the monthly repayments on time, that's going to create quite detrimental to a person's credit rating. And if they want to move on to purchase another property in future, for example, it's going to be quite difficult for them. So that's where refinancing comes in. I think the earlier point that I've shared, if the monthly installments are unbearable or it's really causing a drain on the person's financials, they can consider stretching that loan tenure, right? And when they stretch that loan tenure, like by 10 years, that cash flow or the money installment comes down, which then improves their cash flow, right?
Right.
So there are certain things like if there are requirements. So when we speak to our clients and we understand that okay, this is a requirement, then we say okay, you know what? Instead of taking a shorter tenure, extend your loan tenure. You can always do that, right? At the very beginning or so, right? So that will help to alleviate some of the burdens that a person has.
So in the event that they have to sell the property within the 2 years lock-in period, for example, there's really no way to... So they still have to pay that.
If they don't have a waiver of penalty due to sale, they would have to pay that penalty, and depending on the outstanding loan amount, sometimes my clients, they would just factor that into like the selling price.
Okay. They just factor the penalty into the selling price.
Yeah, so
okay.
if the penalties are going to be like $10,000, $15,000, then you just factor that into the selling price as well, you know.
Right, okay.
Yeah.
And for existing homeowners who wants to refinance their property, is it a good time to consider refinancing, or perhaps what's the pros and cons for refinancing?
Yeah. Before you refinance, there must always be advantages before you refinance. And I think at this point of time, especially, if you have signed up for a mortgage like a couple of years ago, or maybe 3 years ago, your rates should be quite high. Because if you sign up for a mortgage like 3 years ago, your thereafter rates will be pegged to SIBOR. And SIBOR is much higher than SORA at this point of time. SIBOR, you're looking at like 4% at just the base rate itself. You haven't added your spread to it.
Right.
So clients who haven't refinanced, who are on SIBOR, you're going to pay a lot more. If you had refinanced like a couple of years ago and you're coming off the lock-in period, and for example, if you're pegged to like a board rate from the banks, board rates have also increased quite drastically recently as well. So it's always a good time to refinance to bring that interest down. But we will do a comparison. At the end of the day, if someone comes up to us and say, hey, you know what, this is my interest rates, and we say, hey, actually your interest rates at this point of time is still pretty okay as compared to the market interest rates. And if you refinance, in terms of savings-wise, you're not going to get a lot, right? The only reason why you might refinance is because you might refinance into a fixed interest rate. Because you're on a variable interest rate and you want to buy that security, you move into that fixed interest rate. But if you say, hey, Clive, I think I'm in the narrative that interest rates would come down in the near future, I don't mind just remaining on a variable interest rate. Okay, maybe not refinancing at this point of time. Maybe we'll just monitor the markets, we'll monitor the mortgages, and if anything happens or if we see anything going to happen, then we will prompt you and say, hey, I think we got to take action now.
Right, okay.
So refinancing always has to come with its advantages first. Otherwise, there's really no point refinancing.
Okay,
Yeah.
because I do know people that it's always highlighted that when it comes to refinancing, they have to resubmit a lot of documents all over again and stuff like that. And especially for some of them where there's a change in the salary, in their income. I know maybe previously they used to have a higher income, and then now due to a change in their job scope or something similar, they have drawing a lower salary.
Yep.
They felt that going through the refinancing, whereby submission of all these documents might be a challenge for them.
Actually, that's quite a common misconception actually. The process of, let's handle the process first. So the process of refinancing can be made quite easy today. Certain banks, ever since COVID, they've gone on a digital path. And certain banks have like an online submission where most of your information, like 90% of your information, can be downloaded via SingPass, right? So you only have to upload like, your pay slips, or maybe like the outstanding loan statements. So the process has become relatively easy, right? And usually, we understand that, hey, there's going to be a lot of documents. So our guys on the ground would also meet up with our clients to actually extract the documents for them. So it's less of a hassle. Now, the other question that you mentioned was that, what if there is a change in income? What if I used to earn this amount, but now I'm earning lesser due to, the job market, which is not doing well, for example? Then it depends, right? There are two things that we can do. First thing, if the property that you're owning is for your own occupation, so it's like owner-occupied, there are exemptions that the banks give you, right? So like there are total debt servicing ratio exemptions. So instead of having a 55% TDSR, you may have 80%, 100%. So that makes it easier to refinance. Plus, if for example you haven't stretched your loan tenure, you can stretch your loan tenure, and for that same income or for the income that you're earning now, you can actually borrow a little bit more, which would support the loan. So there's this thing that you can do which makes it easier if it's an owner-occupied property. If it's an investment property, rental income can be taken into consideration as well because you're renting out the property, right? Provided you have like a remaining of like 6 months of remaining lease, the banks would recognize your rental income. That would boost your overall loan eligibility. But let's say in the worst case event, right, there is no rental, it's an investment property, no one is staying in the property, you're just having it there, which is unlikely.
Burning money.
It's burning money, yeah. And your income has dropped. Right. And now in order to refinance, if it's an investment property, the banks will strictly apply the total debt servicing ratio of 55%, right? Then what are the instances or what can be done to basically refinance the loan? You can artificially increase your income in the correct way, right? By doing a pledging of funds or a showing of funds to the banks. So if you put a sum of money with the banks in a fixed deposit account, the banks would recognize that money and they would translate that into an income that would boost your loan eligibility. That's
Right.
one way. The other way is like if you say, hey, it's too restrictive for me to put the monies into the bank, but I do have monies in the bank account. You can always just show the banks that you have monies in the bank account, and they would translate that into an income that can also boost your loan eligibility.
Right.
Of course, because you're just purely showing, you're not putting the monies there, you've got to show a bit more.
I see, okay.
Yeah, so those are the ways that you can use to basically refinance, even if there is a change of income or commitments, for example. Yeah, so it's important to basically understand what they have, what the requirements are before knowing what we can do.
Okay. And what happens to those group of people who forgot to refinance if they are on a loan package of 2 years? What happened on the 25th month? Does it still follow the previous rate or?
In the contract itself for mortgages, they will always tell you, okay, within the first 2, let's say for example, if you're on a fixed interest rate and you're paying 1.5% for the first 2 years, on the third year and thereafter, it's always pegged to a variable interest rate. So the banks would say, okay, on the third year, you'll be pegged to a 3-month SORA plus a spread of 1%. So if you don't do anything and it goes to the third year, the banks would just apply whatever 3 months SORA is at that point of time, and they'll just add a spread of 1%. To that, right? So if you do that now, you're probably paying 4.25, 4.5%.
Which is much higher.
Which is much higher than the rates at this point of time. So it's always good to always track the mortgages, which is what we also do. So like usually before you come up the lock-in period, about 4 months you want to start doing something. You don't want to wait till the day that you've come out of the lock-in period,
right?
Because you still have to serve like a 2 months notice to the existing bank. So if you come out of the lock-in period and you do something about it, you've still got to wait for 2 months,
right?
Which may be, which end up like, you'll be paying higher interest rates for the next 2 months. So we want to get that process started before. Yeah, right.
Yeah, that's very good advice for our viewers out there. So perhaps when you secure the 24 months, maybe on the 20th month, you just key in your calendar a reminder to check around the refinancing packages available. Yeah. Okay, so earlier I shared that one of my customers felt that it's very troublesome to refinance. They have to do a lot of submission, they have to do this, they have to do that. But just maybe for the understanding for our viewers, what would be the timeline that probably this whole process would take?
Oh, okay. So it can be even as fast as a day.
Wow.
Meaning to say that, like I mentioned earlier, there are certain banks that allow you right now, they're going very digital. You make a submission, your information is downloaded via SingPass. You upload some documents like they don't have access to, like your pay slips, for example, and the outstanding loan statements. And if it's a very straightforward case, straight through, you can even get the approval on the same day itself. And the client can even sign the loan on the same day itself, right? Yeah. Then after signing the loan, of course, after accepting the letter of offer, the lawyers would then have to serve a notice of redemption, right? So the lawyers would come in and they would ask you some questions first. For example, like, are you out of the lock-in period? Just to make sure everything's okay. And once you've answered them, they would officially serve that notice to the existing bank. And that will be the time where the 2-month period starts, because you have to serve a 2 months notice, right? So as soon as one day can get the loan approved, the next day we get the redemption notice served. 2 months later, your mortgage pops over to the new bank.
Right.
It can be as fast as that.
As fast as within a day.
Yes, as fast as within a day. For more complicated cases, of course, the loan approval takes a little bit longer. But generally, loan approvals will take, I think, within a week or 1 to 1.5 weeks to get the loan approval, right? It wouldn't take too long unless the case is really, really complicated where we have to seek multiple level of approvals from the bank. Then yes, it can take a little bit longer. But if we don't go through that digital way of submission, we go through the manual way of submission, actually extracting the documents can also be quite an easy task, because everything today is digital. You log into your IRAS, log into CPF, log into HDB, with all with the very specific steps. I think document extraction probably 15 minutes.
Right, okay.
About there, yeah. It's just that everyone thinks that, there are like 10 documents to submit. Oh, so many things, it's going to be a hassle to do that. But if you really get to doing it, I think it's pretty simple.
Yeah. So what happens in the event is a couple purchase, husband and wife, but their age difference of between 5 to 10 years. So would they be based on the average of? Yeah,
good question. It used to be in the past where you recognize the youngest borrower. I think for some commercial properties or some commercial loans, when you have a few directors, some banks still recognize the youngest director, correct. But when it comes to residential properties, it's no longer the youngest borrower, it becomes an income-weighted average age. So they'll take your income, your age, your spouse's income, her age, and there's a formula that determines what your combined age is going to be, right?
Right.
So generally, if you're older, it skews to the older, but it also, another factor is depending on income. I can be 50 years old, my spouse can be 30 years old, but my spouse is earning a lot of money, that income-weighted average age goes down as well. So then the loan tenure goes up. So now it's based on an income-weighted average age.
I see, okay. And would that be part of the reason why some borrowers insert their children's name who just started working?
That may be the case as well, but it also depends, because if you first started working, I mean, generally income is not that strong. And if you're buying with someone who's like 50 years old and the person has a very strong income, the income weighted average age still goes up.
Right.
But there are different considerations involved as well, because like I mentioned, you can always pledge and show monies. And if you pledge and show monies under that younger borrower, and now that younger borrower earns a larger income, then the age goes down. Right? The average age goes down.
Right.
So you can borrow a longer loan tenure. And when it's a longer loan tenure, you can actually increase your eligibility.
So maybe you can share with us what's the outlook for mortgage loans in 2023?
Yeah. I think for the whole of 2023, the narrative is still that interest rates are going to stay elevated. Interest rates are going to probably increase a little bit. I mean, if you look at what's happening in the US, the narrative currently is that interest rates will probably go up, or they would continue hiking interest rates for maybe another 2 or 3 times. Right? This is the current narrative. As a result, interest rates in Singapore can also be expected to be at elevated levels, right? But the considerations are also plentiful. It also depends on local context, local liquidity. Are there enough borrowings or not? Competition, for example. So that would determine how interest rates would be at the same time. But I think generally, for the next year at least, interest rates would continue to be on an upward trend. So if anyone who's looking in the short term, then probably a fixed interest rate would suffice. But at the same time, I think, like I mentioned, there are a lot of ways to avoid paying higher interest rates. I mean, one of the ways that a lot of people are coming to me and say, Clive, I want to make a partial repayment, right? Sometimes, now, making a partial repayment on the property is good because you pay lesser interest, and that's the whole point of it. But making a partial repayment onto the property just means that the cash becomes a little bit illiquid, right? Which may be a bummer. For example, if the economy really goes into a recession, then you want to have cash because that's where you start picking up things at discounts, right? So having the ability to not be able to use the cash is going to be a downside. So I always tell my clients that why not, if you have this cash to down pay on a property, to save on interest, shorten your loan tenure. Instead of taking a 20-year tenure, 10-year maybe, because when you and I know taking a 20 years versus 10 years, you're going to save a lot of interest.
Yes,
right?
definitely.
So why not take a shorter loan tenure, pay off more, right, of the principal, bring your outstanding loan amount down faster, but when you need that cash, it's still there, right? Yes, monthly installment will go up, maybe $2,000-3,000, but it's not going to create a dent in your pocket if you have $200,000-300,000 to pay down on the property.
Right.
So why not have access to that liquidity while saving that interest? And at the end of the day, for example, if you say, hey Clive, now I need the cash flow, stretch your loan tenor then, right? Pull it back up. So you do have that flexibility or that freedom to adjust your cash flow.
Right.
Rather than put it down to the property, okay, good. Now I need the cash, okay. We take out the equity term loan, banks charge you interest. Maybe at that point of time, due to your income, you can't take out the full amount. There are a lot of hurdles. So I think considerations like this would determine whether you would go for a fixed or variable interest rate to save on interest or not. But yeah, in the short term, interest rates still going to remain elevated.
Okay, so recently I ran into someone who is very interested in buying a leasehold 99 years property because of the en bloc potential. But of course, the challenge is that the remaining lease is about 60 to 62 years thereabout. So how would you advise in terms of financing and the usage of CPF?
Yeah, so there are certain restrictions on the amount of CPF that you can use currently. Now, generally, the rule of thumb is if the youngest borrower plus the remaining lease of the property doesn't exceed 95 years, right, doesn't exceed 95 years, there is going to be a limitation on the amount of CPF that you can use on the property itself. For easy gauge, I mean, clients can actually go onto the CPF website, put in their age, put in the remaining lease of the property, and they would generate how much CPF you can actually use on the property itself. So that's quite easily identifiable. Now, the next thing about the mortgage is this. If the banks would always say, generally, that at the end of your loan tenure, we would require at least 30 or 31 years remaining lease. So for example, if the property has a remaining lease of 50 years, and the banks require at the end of your tenure to have a 30 years remaining lease, which means to say the maximum loan tenure you can get as a borrower is 20 years. So there's a cap, right?
Right.
So of course it depends. Generally, most of the banks will tell you that they will require 30 or 31 years. Some banks, depending, just require like 20 years, for example. So I do have clients, right, who purchase properties even in like the Tiong Poh area, I mean the Balestier area, where the leases are quite short, right? They would have to search for banks like these that would require only like a 20-year right, remaining lease, so that when they borrow, I mean, they still have like a 20 or 30-year kind of loan tenure to play with, which increases eligibility.
Right.
Yeah.
Okay.
So that's an important point to take note of, because if the property is any older, and after taking up 30 years from the bank, you are left with 15 or 20 years, it impacts your eligibility, because a shorter loan tenure reduces your loan eligibility. So that's something you got to take note of.
Okay, so the golden number is 30 years. So assuming in the example, the property still has a remaining lease of 60 years, it's not too bad as compared to...
It's still okay, because your client can still take on like the maximum of 30 years.
Right.
Yeah, correct.
Okay.
So not so bad. Yeah. But I think another thing to consider, I mean, if this is like going en bloc, I think that's fine. But some people, they say, hey Clive, I just want to buy this because I love the property. But I will always ask them first, do you intend to sell in future? Because if you do intend to sell in future, if the property has a remaining lease of like 40 years, by then, the next person who comes in can only get a 10-year loan tenure.
Yes.
That's going to be an issue for the next person. Even if he or she wants to buy, it's going to be an issue for loan eligibility.
Right, okay.
Yeah.
But in terms of loan to value, 75%,
Still the same.
still the same, it doesn't affect anything.
Yeah.
All right.
Yeah.
Okay, one last question before we let you go, Clive. I'm sure many of our viewers would like to find out from the expert, what would be your 3 best advice for borrowers when looking for a bank loan?
Yeah. I think, number one, the cheapest is not always the best.
If it's cheap, it ain't good.
Yeah, I mean, it may be depending on the situation, on the circumstances, but the cheapest may not always be the best. Always scour the market to find packages that would give you features that would actually help you, or provide you with certain hedge, or provide you with certain protection. Right? There are a lot of packages out there. And there is no one package that would fit everybody. So that's the first advice. Number 2, for people who are looking, for example, to purchase the properties, it's important to look 2, 3, 4, 5 steps down the road before making a decision today, right? On the packages that you're going for as well. So a lot of people come to me and they say, hey Clive, I have the intention to want to decouple in future too. Right? Then I'll say, hey, besides thinking about the kind of interest rates you want to go for, have you thought about the manner of holding that you want to hold the property in? Joint tenancy, tenancy in common, which one? What is the percentage going to be? Is it 99-1 all the time? Is it 80-20, 70-30? What are the considerations for those? Because these decisions will impact you later when you decouple. You may think, okay, never mind, just go to the lawyers. Lawyers say, equal shares, okay, equal shares, and then down the road you realize, oh no, now I want to decouple. Yeah, I should have done it a little bit differently at the very beginning. So that is the second consideration. And number 3, if you are looking at whether you're looking at refinancing or purchasing a property, I think in today's context, I think it's quite important to keep expenses or keep commitments to in check, right? In a higher increasing interest rate environment, that will add an additional burden to your cash flow.
Right.
You want to be able to have some buffer for rainy days. In the event that you're on a variable interest rate and interest rates really do continue to increase, can you take that blow? Can you afford that additional cash flow? If you're buying a property, you always want to make sure that commitments are in check, because that would impact your loan eligibility. So especially today when inflation is high, prices are always going up. We just want to be a little bit more prudent and make sure that we have our expenses and commitments in check. I think that's important that many people neglect.
Thank you very much, Clive. Indeed, there are lots of consideration for you homeowners to think about when it comes to financing or refinancing your property. As always, I emphasize the importance of getting the right person for the right job. I'm sure you will know who to think about the next time you need to learn more about mortgage loans. This is Alex Chua from Home of the Elite signing off, and thanks for watching this program.